Welcome to Value Vest Daily, where we analyze the best value and momentum investment opportunities. Today, we are diving deep into a company that's making huge waves in the AI space, a real lightning rod for debate, CoreWeave.
So, let's get right to it. Is this company the next massive AI investment, or is it a super high-risk gamble? This company is right at the heart of the AI revolution, but its valuation has just gone through the roof, and that's sparking some serious debate. So, the big question we're going to tackle is this. Is CoreWeave a once-in-a-generation shot, fueled by just mind-blowing growth, or is it a house of cards, burning through cash to stay afloat? Let's dig in and find out.
All right, here's how we're going to break it down. First up, we'll see what makes this company a hidden powerhouse in the AI world. Then, we'll do a real deep dive into the fundamentals. After that, we're decoding the technicals. What are the charts telling us? Then we'll check out what the big money is doing, the price targets. And finally, we'll pull it all together for the final verdict.
So first things first, what exactly is CoreWeave? Well, think about the AI boom like the old California gold rush. You've got all these companies out there, like OpenAI, digging for gold. But CoreWeave, they're not digging for gold. They're selling the picks and shovels. They are a super specialized cloud provider built from the ground up for one thing and one thing only, providing the insane amount of computing power that AI needs to exist.
And let me tell you, the demand for these picks and shovels is, well, it's just off the charts. Absolutely staggering. Let's just look at the numbers for a second. In 2023 alone, the company's revenue literally exploded by over 1,300%. Yeah, you heard that right. It went from just $16 million to $229 million in 1 year. That's insane.
And you might think, okay, that's a one-off. But no, the growth didn't stop there. In 2024, revenue surged again, this time by nearly 740%. We're talking about rocketing up to almost $2 billion. This isn't just a company that's growing, folks. This is a company that's detonating. It's on a whole other level.
Now, I know what you're thinking. Is this just hype? Is this a bubble? Well, check this out. This growth is secured. CoreWeave has a $55 billion revenue backlog. That's future business that's already locked in with long-term contracts from the biggest names in the AI game. $55 billion, that's some serious stability.
So the big question is, how on earth does a company pull off this kind of growth? Well, it all comes down to their competitive advantage, what investors call a moat.
And their moat is something called AI native infrastructure. Okay, so what does that mean? Think about the big cloud players, like Amazon or Microsoft. Their clouds were built for everything. Websites, data storage, the whole shebang. They've had to adapt to handle AI. But CoreWeave, they were built for AI from day one. It's in their DNA. Their systems are custom designed for the massive GPU power AI needs, and the result is pretty staggering. They can train AI models 2 to 3 times faster than their biggest competitors. That is a huge advantage.
And this advantage is protected by what I like to call a 3-layer moat. It's pretty solid. First, they have this incredible partnership with NVIDIA. It's almost symbiotic. This basically guarantees them access to the latest and greatest GPUs, which are like gold dust right now. Second, they were smart. They made an early pivot from crypto mining, which let them snatch up critical real estate and power for 32 global data centers before anyone else. And third, they've locked in the big players. We're talking OpenAI, Meta, with these sticky multi-year contracts that are hard to get out of.
But, and there's always a but, right? Here's the other side of the coin. Building this kind of empire is incredibly expensive. We're looking at a market cap of over $42 billion, and yet the company still isn't profitable. Just look at these numbers. You've got negative earnings per share, which means there's no PE ratio to even look at. Return on equity is negative, and the free cash flow, deeply negative. They are just burning through cash to fuel this insane growth. And where's all that money coming from? You guessed it, debt. This right here is probably the single biggest red flag, the biggest risk for the company. A massive 485% debt-to-equity ratio. They've taken on enormous loans to build out all those data centers. And sure, the revenue growth supports it for now, but it's a huge vulnerability. If that growth slows down, things could get ugly fast.
This all came to a head in their latest earnings report, which honestly sent some really mixed signals. On one hand, they beat expectations on revenue and earnings. Great. But on the other hand, they had to cut their guidance for the full year. Why? Because of delays in building out new data centers. That, as you can imagine, spooked investors and probably dinged the valuation of its private shares. Okay, so that's the fundamental picture, right? You've got this explosive growth story on one side and this high-risk debt story on the other. So now let's pivot and decode the technicals and see what the charts are telling us right now.
And at first glance, the picture, well, it looks pretty bearish, to be honest. The current price is sitting way below both the 50-day and 200-day moving averages. That's a classic sign of a downtrend, both short-term and long-term. But hold on. There is one indicator here that is flashing a potentially massive, massive signal. And that's this number right here, the Relative Strength Index, or RSI. It's sitting at 14.75. Now, to put that in perspective, anything below 30 is generally considered oversold. So a number this low, we're talking deeply oversold territory. It suggests that the negative sentiment has been so extreme, so piled on, that the stock might actually be undervalued right now. It could be primed for a serious bounce.
Okay, so we've got these conflicting signals. The fundamentals are a mix of amazing and scary, and the technicals are bearish with a huge oversold signal. So what does the big money think? Where is Wall Street placing its bets? Let's take a look.
Get this, a whopping 75% of CoreWeave is owned by the giants. We're talking Vanguard, BlackRock, Fidelity. And it gets better. Just last quarter, Fidelity added another 2 million shares. And NVIDIA's own venture arm, the company that actually makes the tech that powers all this, they increased their stake by 15%. If that's not a huge vote of confidence, I don't know what is.
And you can see that confidence reflected right here in the price targets from analysts. In the short to medium term, say 1 to 3 years, the average target is sitting in a range between $128 and $155. From where the stock is now, that represents a potential upside of anywhere from 66 to a full 100%. Not bad.
And if we look even further out, say 5+ years, the targets get even more bullish. We're talking a range of $250 to $400 a share. Now let's think about what that means. If CoreWeave can actually execute its plan, that implies a future market cap somewhere between $200 and $480 billion by 2030. That's getting into mega cap territory.
Okay, so let's recap. We've seen the absolutely incredible growth. We've looked at the deep moat they've built. We've also seen the really risky balance sheet, that oversold chart, and Wall Street's pretty clear conviction. It's time to pull all this together and come to a final verdict.
So here it is, the bull case versus the bear case. On the bull side, you have that explosive AI-fueled growth that is just undeniable. You've got a deep moat backed up by a $55 billion backlog. You have strong institutional backing from the smartest money on the street, and the stock looks technically deeply oversold. But on the bear side, you have that crushing debt load and the burn rate. You have a very real execution risk. Can they build these data centers fast enough? You have intense competition from the giants, and of course, the ever-present threat that a big recession could slam the brakes on AI spending.
All right, before we wrap this up, I have to give you the mandatory disclaimer. Please remember, this is for informational and educational purposes only. This is not financial advice. You've always got to do your own research before making any investment decisions.
So there you have it. CoreWeave is a classic high-risk, high-reward play. The potential upside is just massive, but the dangers are just as real. It's a fascinating one to watch. For more deep dives like this, please subscribe, like, and share ValueVest Daily so you can learn about totally unbiased daily opportunities before you put your money to work. Oh, and hey, one more thing. Please put in a comment if you want us to deep dive any specific ticker symbol. We'd love to hear from you. Thanks for joining us.